Hello and welcome to LiveSquawk's Market Talk Preview Show on Thursday, 30th of April 2026. Today's episode previews the impending Bank of England and European Central Bank interest rate decisions later today. In the case of the Bank of England, the announcement is scheduled for midday British Summer Time, 11 GMT. And for the ECB, it will be announced at 13:15 GMT, 14:15 Central European Time. With the press conference then at 13:45 GMT, 14:45 Central European Time. To help me break down expectations for both central banks, I'll be joined by Eric Culp, LiveSquawk's European editor. I'll bring Eric in shortly, but before that, just a quick disclaimer. The content provided on this channel is for informational and educational purposes only. We're not licensed financial advisors, and none of the information shared should be considered as financial, investment, or trading advice. Please conduct your own research, consider your financial objectives, and consult a qualified financial professional before making any investment decisions. Investing and trading on financial markets carries risks, and past performance is not indicative of future results. We are not responsible for any losses or gains that may result from following the content on this channel. And with that out of the way, we'll get into the reads. Just a quick look at, we'll start with the Bank of England here, again, facing a multifaceted trade-off to keep inflation on track. We're looking for a voting pattern of 8-1 to keep rates at 3.75%, with energy costs evident in March inflation figures, countered against likely to be sluggish growth at the back end or second half of 2026. Analysts expect generally that rates will stay on hold for the rest of this year, with the risk being more towards a hike than to a cut at this point in time. It's kind of the message we've seen from a number of central banks so far this week, starting with the Bank of Japan, which is on a hiking cycle effectively, but wants to wait out the uncertainty and to get a better view and a better read on both the domestic economy and the global economy. And that's really what we've heard from the FOMC, which we heard from yesterday, and the Bank of Canada was on a similar train of thought as well. So getting back to the Bank of England then, just on the preview, which is up on the LiveSquawk website, you can go there and have a read for yourself. But following a two-day meeting, the Bank of England's Monetary Policy Committee is widely expected then to keep its benchmark bank rate unchanged at 3.75% when it delivers its decision at midday today, London time. Recent commentary suggests, as I said, an 8-1 vote split in favour of a hold, with the bank's chief economist Hugh Pill the likely lone dissenter. He expects to vote for a quarter-point hike, according to analysis. On bank guidance, Bruno Scarica of Morgan Stanley expects a message centred on uncertainty and a readiness to act towards second-round effects if they emerge. On balance, we see more focus on trade-offs than in March. We see the Bank of England on hold through this year, she said. So getting into the reads then, I'll bring it up. Hello, Eric. How you doing?
Good, Harry. A busy day today, isn't it?
It's been a busy week, if I'm honest. One of those sort of weeks where just it all comes together, both in the data front and on the central bank front, with a number. I think we had about 15 central banks, about 5 major central banks reporting this week. So thankfully, I think this is the last of the central bank days, really. So we'll get the Bank of England, as I said, and then we'll get the ECB. We'll come on to ECB in a bit. But in terms of the Bank of England, I've got a note here from UBS, and it's from Dean Turner, who's an economist at the London branch of the Swiss bank. With interest rates likely to remain unchanged, investors will be hanging on every word of guidance and scrutinising the fresh set of forecasts for clues as to the direction and timing of the next move for the Bank of England. As we and many other economists have repeatedly pointed out, there is little that policymakers can do to address or prevent the coming rise in prices, unless Andrew Bailey and his fellow NBC members announce they are chartering a boat and heading to the Gulf with a view to reopening the Strait of Hormuz themselves. Thus, all eyes will be on any evidence of second-round effects, such as material rise in wage and price-setting behaviour, and how much monetary policy may need to respond to the circumstances. Such effects were not evident in last week's CPI data, while headline inflation accelerated, mainly due to higher energy prices. Core inflation continued to decline. Besides, although inflation targeting is the Bank of England's key mandate, it cannot ignore the impact of the already fragile outlook for the economic growth. Some decent points there, and we won't labour on this, but one of the things I have noticed in the research that I've seen is that, and a number of economies have shown this, that outside of energy, really, pre the conflict in the Middle East, we were looking at subdued inflation and cooling inflation and sub-target inflation coming through, and maybe not for the, again for the European Eurozone as well, but that's all been put to the sidelines here. And I don't know if you agree or not, but it seems to me that central banks are weighing up slowing growth on the one hand versus targeted inflationary pressures on the other. And I mean targeted by the fact that it's really energy component for the most part that is holding up overall inflation. And if you look at the labour market, look at wages, generally speaking, we are looking at wage growth that's starting to look a little bit on the soft side, a little bit subdued. I guess you're seeing that in the euro area as well, to a lesser degree, or more so, I guess, Eric.
Well, I mean, on the inflation side, the numbers came out today. The headline's at 3%, at least the preliminary number for April for the Eurozone. It's a touch above what was expected. 2.9 was expected, so it's in there. But the core rate stayed at, and actually it didn't even stay, it receded to 2.2 from 2.3, which was a little bit unexpected. Wage growth, and I think I'm not really sure. I haven't been looking at it recently. What I remember seeing before all this started was that food prices, fresh food prices, were a bit of an issue. But as you said, it was below target in February. It was 1.9. Yeah. So at least the headline rate. Now, you're also dead right. Everybody's waiting. To me, this is an analogy would be that somebody slapped the horse and the person riding doesn't know which way to steer
it. Yeah. Well, I've got that in my head now and I can't agree with it. But yeah, it seems to be the case that for major central banks, and I think for central banks generally at the moment, and to a degree, governments, until we get some sort of resolution in whatever shape that may be, these uncertainties. I mean, you can't make decisions on this uncertainty. What we do know is that we're at an impasse between the US and Iran at the moment, with both sides looking for demands that the other side do not want to meet, and therefore there's this continued blockade in the Strait of Hormuz. As we all now know, 20% of the world's oil supplies go through or transported through that waterway, and with that blockade, it creates issues not only for the region but, as I said, globally, for maybe less so for the likes of the UK, but definitely an issue for the Europeans in terms of where they get their gas, where they get their energy and their oil from, to sort of fire their economies. And so it's this situation that we've seen. As I said, it's been repeated constantly this week from central banks that until this uncertainty is lifted, or there's a clearer picture one way or the other, we're likely to stay on hold. Now, a number of rate markets now are looking at the Bank of England to stay on hold in the near future, at least, and potentially for the rest of this year. That's definitely now more the case, I think, with a risk of a potential hike for the US as well. I think you can put Canada, maybe, of the major central banks, following was it Wednesday's decision, might still err on the side of a cut, but I think I don't think there's any rush for central banks to move at this time at the moment. Looking at the piece I've got here, again, messaging is hard to see anything but guidance signaling potential action if second round effects build, says Skarika, adding that, noting that a greater emphasis on balancing inflation risk against growth impact of tighter policy. Now, everyone also automatically went to, well, we're going to have to hike rates. Central banks will have to hike rates. Inflation's gone on the rise. But as I said at the start, this appears to be focused around the energy. And if you look at some of the other subcomponents, we're not seeing those same levels of upside pressure like you saw today with the core, Eric. That came in, what was that, 2.2%, I think you said.
Correct.
In line with forecasts, and therefore not really showing any of that heated sort of pressure that we're seeing on the overall number. If we turn to the ECB then, what do you think their messaging is likely to be for today? And I've got your preview. We can also get Eric's preview up on the website as well. ECB set to hold rates as war, fans, inflation, and growth fears. Although, market expects a hike in June. I know we were already kind of in that sort of mindset for the ECB that hikes were more likely than cuts. What's your initial read on what we're likely to see?
I think there'll be nothing today. I think it'll be the typical cautious rhetoric, as cautious as it can be from the European Central Bank. Christine Lagarde is often she's gotten better in messaging. In the past, it was always like she felt like she had to say something. I think she's learned that every time she says something, something happens. So now I think she'll be towing the line, which is, hey, we don't have enough information yet. We're still watching the situation. We're ready to react. It's also, I think it's fact-finding now. Today's data, they're still a little bit backward looking, especially for the growth number. The GDP number of 0.1% for the Eurozone, that was lower than expected. I think part of that may have come from Ireland, which, it had a 2% drop quarter on quarter. Ireland's data is always volatile. If you look at the big economies in Europe, I mean, Italy, they were all better than expected, except for France, which was flat. So the other big four were all, like Italy, Germany, Spain, they were all better than expected. So there's still some growth there. Weirdly enough, if you look at the PMIs, manufacturing has surged for Germany and France, well, especially Germany, right, and the UK. And the reasoning behind that, according to the analysts, is that there's higher prices coming. Everybody expects more inflation, and they're concerned about raw material supply, so they're producing as fast as they can now before that happens.
So building the stockpiles at the moment.
Exactly. That's exactly what's happening. Carson Bresky at ING says there's an insurance hike coming next month. I think the question that people need to start asking is the ECB and our other central banks going to be a bit trigger happy because of what happened after the pandemic? Sure, energy prices surged, but what you're not seeing is pent-up demand from consumers who are all locked up at home. Right now, it looks like consumers are, they're going to hold on to their money because they're concerned, as they should be, about inflation and about the entire situation. I mean, there's a war on. And like you said, one thing the Europeans have to worry about, especially the Germans and other countries, is their gas supply, right? Mm-hmm. And they should start replenishing the stocks soonish. And gas is really expensive. Natural gas is really expensive right now. This has put Germany and other European countries in a weird position that they have to buy from the Russians, right? And they don't want to because of the war in the Ukraine. So it's just adding to this feeling of uncertainty within the Eurozone.
Well, it seems like a case of self-flagellation for the West at the moment in this war that we've seen. Again, not everyone's party to it, but everyone's suffering from it. It's worth noting as well. I mean, I'm looking at some notes here. We had the Bank of England's decision maker panel and agent summary that suggested that the energy shock was more likely to weigh on company margins and demand than to generate wage price spirals. This is from this UBS piece as well. So again, this idea that hikes are the answer unless you're going to, like the report said, unless you're going to get on a boat and go over there and open the strait yourselves, and I wouldn't suggest that as anyone, but monetary policy isn't really the tool that's going to help. Really, like you said, we have to wait for second round effects to take effect in order to try and mitigate some of that. So, I mean, I agree in that sense. I think being a bit trigger happy with hiking could come back to bite you in the backside at a later stage, especially if we do get some kind of end to this conflict in the near future. Yes, there will be, you have to rebuild the supply chain and everything else and bring everything back in, but that just stalls activity. Do you think there's a possibility the ECB is like, well, you said it, trigger happy, so it's getting ahead of itself and it may live to regret even sounding as hawkish as it maybe some of its members do at the moment?
Like we were talking before we started talking, I think the concern is always you're always fighting the last war, right? And so they're backward looking. They're trying to fix any problems they may. It's normal. You look at your past, made mistakes. Okay, I'm not going to let that happen again, even if the entire environment's different. And you're right. The entire environment is different right now. Okay, this is all driven by what's starting to look like military misadventure in the Persian Gulf, and it doesn't seem like there's any time this is going to end. So how do you compensate for this? That's the real question right now. A lot of the problems are not even in this area, right?
Yeah.
The countries that are really getting hurt are the Asians, right? Because they're the ones that are most reliant on energy from that area. But the Europeans are reliant on LPG, or LNG, and how that shifts. It's good news for the United States, good news for Russia, but costs are going to go up. Okay, that's a given. It's already happened. What Brent hit? Did it hit 120 again today? I think
4-year highs. I think we've seen. Yeah.
I mean that's going to hit everyone on the planet. Now it's going to hit some people more than others, and the Europeans and the UK. So they're going to have to deal with that perhaps a little bit more than a country with fuel or with oil like the United States. But still, hey man, it's a commodity, right? And you pump it and you send it to the people who pay the most money for it, and it can pay for the shipping. Everybody's going to hurt. Back to the European Central Bank. Sorry, I got on a fun little tangent there. They're going to have to watch and wait. I mean, yeah, like I said, ING's Bresky called it an insurance hike. Everybody's, or not everybody, but mostly everybody, virtually everybody who watches the market expects a hike next month, or not next month, but in 6 weeks at the June meeting. Yeah. The question is what happens from now until then. If there's a resolution, maybe things will change. I check Polymarket. I don't think there's going to be one, man. I don't think anybody's betting on it, but
well, we've done 60 days now, and I think the president said that this will be over in 6 weeks. So
that guy says a bunch of stuff about timelines, and it almost never proves correct. The question, of course, is this going to cause, or one of the questions is this going to cause more internal issues in the United States politics, which are already haywire? Is because he's only has the war powers for allegedly 60 days, or at least according to law. But there's people who say, you get another 30, and then if Congress doesn't push back, who cares? This is just something else heaped upon the fractured decision-making process in U.S. politics right now. And that's no good for anybody involved. People are saying the S word already, stagflation. Yeah. And that is terrible for everybody.
It's the hardest thing to get out of. Have you heard much from central bankers on this side of the pond in terms of European central bankers, obviously before the blackout period, but were they kind of fairly neutral in their sort of sentiment, or the usual suspects were saying the usual things about rates?
I think from the ECB, there's general neutrality. I mean, there's a lot of people there, right? But the messaging has been, hey, we have to watch and see what's happening. And that's the smartest thing they can say, right? Because inflation, like we said, the core number of 2.2 today, a little 0.1% percentage point decline, which was unexpected. Second round effects haven't hit yet. And when they hit, we'll have to see how hard they hit, whether they're going to be spread out. That we don't know. They have a bunch of economists right around the corner here. I'm just right around the corner from the ECB. And, they get paid to figure this stuff out. And they're going to have their estimates. The next one's are due in June, which is another reason I think that analysts are saying, yeah, if they're going to make a move, it's going to be next time. And it's probably going to be up, because if you look at inflation, right? To me, back to your point about raising rates and hurting growth, that's could be a bit of an issue. Growth looks okay, but again, it looks like people are stock building right now. They're stockpiling. The Germans are spending a lot of money, less than some people had expected, and in different areas, but they're still spending the money, right? And most economists expect that government investment in defense and infrastructure to boost Germany and thus the rest of the Eurozone. And, other companies from other countries can bid on any of these contracts, right? They have to be allowed to bid because of EU rules. So it could help everybody. And then all of a sudden you raise interest rates, increase borrowing costs, and then people say, yeah, you know what? I don't have access to the type of access to money that I had before all this happened. That can slow down the growth. And then just at a time when the world's fourth largest economy was supposed to start expanding, it's squelched by European Central Bank policy.
Here's a question just to finish on. We'll come back to some of the Bank of England commentary we've seen lately. But do you think Lagarde would give any signal at today's press conference that they're ready to move next month, or will she stay completely non-committal? Because as you said, the market's already factoring in a hike at the next meeting in June. So do you think she gives any kind of hint that there is does a statement do that because the members want to make sure the markets are ready or the public are ready for what's potentially to come? Or do you think they hold their cards that close to their chest and leave it to the very last to sort of give any inkling of what they're doing in June?
That's a great question. I think that's one thing everyone will be watching for, also whether or not she's going to complete her term, which I don't think she'll talk about the latter at all. I'm sure there'll be three questions as usual, because as a journalist, I know my colleagues, and we can be, you can either say thick-headed or tenacious.
Yeah.
Going after information. Yeah. I'm not sure how they're going to message today. They could just go with this standard, we're ready to do anything, we'll react to the market and blah, 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 blah. And then afterwards, sources will start putting out information, suggesting the direction, or, it seems to me that a quarter point hike in June, they could signal it. I don't think they will, though.
Okay, fair enough. Just go back to the Bank of England. Recent commentary from Bank of England officials, really. You have a look at the Governor Bailey. Says too early. This is on the 15th of April, so a couple of weeks ago. Too early to form strong judgments. Markets got ahead of themselves with hike bets. I was expecting one or two cuts before the war. That's from Bailey on the 15th. We've had green rate hike expectations about right after easing. Successive supply shocks mean households are sensitive. UK may not have recovered from 2022 for 22 second round effects. God, I can't say that. 2022 second round effects. That was on the 15th as well. We had Taylor sitting on the hold is already being quite restrictive. Labour market reaction to Iran war is key to decision. But which I find curious, because that would take a few months to see any of that come through, I think, if you wanted to sort of pause hiring or whatever. Agrees with Bailey that markets got ahead of themselves on rate hike expectations. So, and the only one, as I said, Pill is the only one really coming out and says skeptical of the wait and see response to inflation threats. He was speaking on the 17th of April. So I guess from the Bank of England, it's fairly unified, I guess, in one sense, that we're looking for a pause at this time, and that wait and see message will continue to be the message of choice. I think for major central banks for the next month at least, a couple of months, until, as I say, one way or the other, we get some sort of resolution. I personally, on my personal view on the conflict, is this could drag on and on and on. And I don't mean in the violent sense. I think Israel and Lebanon is a situation with Hezbollah, but in terms of the US and Iran, this could go back and forth for a while yet. And uncertainty is something the markets don't like. I know we've seen equity markets continue to rise, but at some point, with all this level of uncertainty and rising oil prices, I'd be a bit dubious about that. But again, that's just my personal view. As I said,
if I can interject here, a couple things. One, back to what the people from the ECB are saying, there has been some commentary that, as Bresky from ING noted, he said optionality is back on the table, ranging from, some of the comments range from, quote, a cut could be needed if the economy moves toward recession, to, quote, market bets on 2 rate hikes, not unreasonable. So yeah, I think that comes from the the usual suspects who want to push. To your other point about the duration of this conflict, I think Axios ran a piece a couple days ago, or maybe even yesterday, that this is a new Cold War. And as someone who's been through the Cold War, I thought, oh, not this again. It's because what happens, it turns into this proxy, secretive, unclear thing that just won't die, right? And I think the U.S. is in way over its head now. If you look at one, cost, two, weaponry used, right, and just depleting their arsenal.
That was Hegseth's yesterday, wasn't it? What we standing at? 20 billion.
25
billion in the first phase of this conflict.
And there's analysts saying that number is, bull. It's too low. And there's questions about, serious questions about high-tech weaponry that the U.S. doesn't have enough of anymore. The Iranians, they look ready to dig in, right? How long can they survive? I don't know. It's their dirt, right? They want it. And is the U.S. going to send troops? There's a lot of analysts saying that. That's the only way to really take control of the strait, and I don't see that happening either.
Well, they've already pulled. Yesterday, they decided to pull the USS Gerald Ford back to the US as well now. So they're actually taking some of their resources away from the region.
Yeah, quickly, the optics are really terrible on that boat. Whether it's the toilets not working, or there's a laundry fire, or the people not getting fed enough. The propaganda war, I hate to say, it's going against the U.S.
Yeah, well, that will flick back and forth, I guess. But I would argue that we've been in a Cold War with Iran, or the US and Iran have been in a Cold War for a number of years already, and we've already seen that via proxies for quite a while now. Thank you very much for your input. You can find both pieces on the LiveSquawk.com website, previews of today's events. I said the Bank of England is first up, and that's at 11 GMT, 12 midday British summertime. The ECB announcement will come at 13:15 GMT, 14:15 Central European time, with a press conference at 13:45, half hour afterwards. Well, we'll hear from ECB's Lagarde. We will get some commentary from the Bank of England's Governor, Bailey, no doubt. There will be a press conference, obviously, because today we've got updated forecasts as well. So we will be looking towards that for some commentary from the Governor and select members of the committee. But you can find both previews set up on the board, and listen in live if you want to take out a free trial of the service to the decisions and the subsequent commentary from officials thereafter. But again, thank you, Eric. And what we'll do is post this to all our social media platforms and to our podcast platforms, and you can listen to this in its entirety then. Thanks all for listening, and we'll be back again next time.